So I'm very happy to be here and glad that so many people came to see a banker talking still. So that is great. And before I come to the topic, as Dr. Green said, I'd like to speak a little bit, I was asked to speak a little bit about what's the investment sentiment like, where do we stand right now on renewable energy targets, or on where the installed capacity is, how does that stack up against the targets that politicians have set and the expectations, what is the path to 2020, what investment is actually needed, and what does that mean for capital to be attracted into the sector? How do we attract this capital? Where does it come from? And how does the investor sentiment look like? So JP Morgan is obviously quite a big institution. I fit into the investment banking side of things. We're split into coverage areas, and within the investment bank, I sit in our natural resources group, which is split into oil and gas and the utilities part. And you see like 5 lovely pictures here. So the team is headed by my boss, Callum Mitchell-Thompson. And then actually also quite unusual for the investment banking industry, we have 3 ladies in our senior coverage team, actually a South African lady and a French lady, and then myself. And then we have a Bulgarian gentleman who is covering Eastern Europe. I am responsible for our coverage efforts on the renewable energy side and for the German-speaking utility area. A little bit of advertisement, or just to say what we actually do for those of you who are less familiar with it. In this coverage group, we are not just doing M&A, but we're also, as Dr. Green said, we're helping companies raise capital, be this on the equity side through equity private placements, through a public listing, or on the debt side, be this, again, capital markets activity, or on the loan side. We're also more recently now involved in project finance here across Europe. But I'd say the majority of my time I actually spend on M&A situations. So companies looking to divest has been the broad theme of the utilities sector over the past few years, unfortunately now, or also on buy-side mandates. As such, we have, within the renewable space, focused mainly on wind so far, because this is obviously the largest area in this space. We've been involved in all the major wind IPOs and the subsequent take-privates of those. Well, we don't just do big situations, but we've also, for example, here in the UK, beginning of last year, raised 200 million for a solar developer called EGA. So a wide variety of situations. We also look up at startups like a biomass company that we're currently working with. But I'll stop it here now. Usually you'll also see the league tables where everyone always comes first. I spared you that part. Now coming to our actual topic, renewable energy, is just a good time to invest now. When we look at what's the status quo actually? Where are we now? It's remarkable to say, at the moment, despite a few years of heavy investment already, we're only at 8.1% globally of renewable energy in the overall fuel mix. This is end of 2012. And this is based on data that's been published by the International Energy Agency, as you can see. So 8.1%, this is still far away from the targets that Europe has set across the different countries of 20% that we actually want to achieve by 2020, or in some cases even more. For 2035, the expectation of installed capacity by the IEA is only 22%. When we look into this 22%, how is that split down and how does it compare to the current installed capacity? Unsurprisingly, wind is the large majority of the installed renewable capacity at this point in time, simply because onshore wind is the most mature technology amongst renewable technologies and also the most cost efficient. Well, I'll have a chart later that looks at the levelized cost of electricity of the different technologies. But at this point in time, onshore wind is the clear leader. In addition, over the last few years, offshore wind has really started to take off. And offshore wind is a technology that we think over the next few years will probably take the growth pattern with 40–50% that onshore wind has taken 10 years ago. So a large chunk of that growth in the wind sector, the blue in the bottom here, in the bottom chart, will come from offshore wind, essentially. When you look at the bottom here, the green is actually solar. So interesting to see that solar has the highest growth potential amongst the technologies. And this is installed rooftop capacity. Sorry, this isn't necessary, or it's probably equally split, but a large chunk of this solar is rooftop capacity. I'm German. I can actually see, or I can testify that the whole of Bavaria, every farmer has cemented their their houses with solar panels and is really cashing in on that. So a lot has happened here already in the last few years. You see from 2010 to 2015, the solar percentage really doubles. It's the expectation, and we're well on track on that. Germany has installed 8 gigawatts of solar only last year, and this is a trend that is continuing. If you look at the regional split in the top chart, who is really the growth driver? That's clearly Asia, and that's the green again here in the chart, with almost 10% CAGR, cumulative average growth rate over the next 20 years, essentially. So that's pretty impressive, and the majority of that is driven by China and by India and Japan more recently, who, following Fukushima, really curbed up their support schemes to funnel solar investment in particular. Europe has much more moderate growth rates, it's only 6%, and the Americas to follow with 7%, so pretty much in line. Now, how does that compare to the targets that politicians have set? If you look at the bottom charts, and I've put this here on purpose, it actually looks pretty good. It's all green. But I find this chart misleading. That's been published by the European Union or some government body, essentially. And that chart shows we are actually well on track to achieve our targets, or we have already achieved the interim targets. But if you look on the top chart, what's not captured in here is all the investments that are required apart from just the generation capacity. If you look at this here really just looks at installed capacity, wind, solar, all the plants that are required. What's not in here is all the investment that is required for the grid infrastructure to be upgraded. I don't know what the general level of knowledge here is, but if you look at an electricity grid that connects, for example, the north of Germany with the south of Germany, and the north of Germany will have huge offshore wind coming on stream, and wind, due to the wind resource volatility, is just a much more volatile source of electricity compared to a coal power plant. That will mean that at some times when the wind blows very strongly, a lot of electricity will be fed into the grid, and at other times, nothing or not much. Nothing unlikely, but not as much. So we just need the capacity to balance this volatility in the grid. A lot of investment is needed in grid infrastructure to balance the load, the volatile load profile of renewable energies. All of this is not actually reflected in this chart. And so the reality is that with a few exceptions, China and Germany maybe, most countries are actually lagging behind their targets. And there's still a long way to go. Now, obviously, the recession hasn't helped, and the credit crisis hasn't helped, has made it much more difficult to finance projects, has had a significant impact on demand, obviously also on renewable demand. You may know that utilities across Europe are facing the most difficult environment over the last few decades with very depressed power prices. And that situation is aggravated, obviously, with more renewable capacity being connected to the grid. So there are still quite a large number of challenges that have to be overcome to fulfill our targets. Looking more at, or drilling in a bit more at, what will that actually mean in terms of investment needs, in terms of dollars required to get there. This here is a chart from Bloomberg New Energy Finance, which says essentially, looks a bit complicated, says essentially that in 2012, 250 billion were invested in the global renewable energy sector, 250 billion. And the majority of that, 60%, the blue bar here, the bottom, went into asset financing, meaning project finance, debt or equity, financing new capacity, essentially. The green part, SDC, is essentially small installations, so that would mainly be solar, rooftop solar. So the majority of investment went into these two areas. And that's what I would like to focus on. The rest, like maybe the yellow part, public markets, new equity, you see how insignificant this actually was. But taking this all together and extrapolating this at the growth rate that we've seen since 2004, 26% per year, that would mean in 2020, we would look at 1.5 trillion of capital invested in the sector, 1.5 trillion. Question is, where does that capital come from? What makes investors invest into the renewable space? Is it attractive? Is it not attractive? When we look at the positive side, first of all, renewables at this point in time, and you see this on the chart here, as you all know, is not yet competitive with fossil energy. It needs subsidies from governments to be competitive. Obviously, there's still a way to go to reduce costs such that it is competitive and reaches what we call grid parity. So it doesn't require any further subsidies anymore. But this chart shows you actually where we are right now, which is the yellow dot, for the different technologies, assuming a return of 10%. So essentially taking the cash flows out of one single project per technology and discounting those with a project return of 10%. And that gives you this number here to break even, essentially. And that shows you offshore wind is by far the most expensive technology, unsurprisingly at this point in time. So it does require a lot of subsidies to be competitive and to be attractive at this point in time. Then PV has really made a quant jump over the last 2 or 3 years. Probably all followed the press of the solar shakeout, where a lot of bankruptcies have happened. But technology costs have come down massively. 2 years ago, we would also see a number north of 200 for this technology. And you see onshore wind, and I'm afraid our analyst has left this out here, but onshore wind, actually, you would see very much in line here with coal-fired and CCGTs. So that is actually already today at a level where it's competitive with fossil energy. But the key point is, given that renewable energy today is still very much dependent on government support, on subsidies, that is a key driver, subsidy schemes to stimulate investment. And the positive news is around the globe, almost 120 countries have renewable energy support schemes in different formats. And we see new support schemes coming, every other month. While there was obviously a lot of negative press here in Europe around the more mature markets, on the positive side, and we look at that in a second, on the positive side is new schemes are coming on and the more emerging markets are becoming more interesting, putting actually subsidy schemes in place. The other point that's important on the political support is Post-Fukushima, obviously the focus on renewables has increased. Germany, for example, is phasing out nuclear energy. So there's just a different level of attention and support that goes into the whole sector, which is very positive. In terms of economic viability, as I just said, I mean, really a lot has been achieved, in particular on the PV side. Has not always necessarily been positive for the manufacturers, but for the economy overall and for the competitiveness of the technology, it's been great. The prices have fallen by more than 60% over the past years, and we're now really looking at a level that is much more comparable to onshore wind. We've seen the same on the wind side with wind turbine costs, in particular on the onshore wind side, they've come down dramatically, and the same we see actually on O&M, like service contracts, and that will make the technology even more competitive. On the offshore wind side, we still have a long way to go, but you see here with the red arrow, that's what we expect for 2020, that the costs will come down significantly in this period of time. And then last but not least, global competitiveness. Partnerships between the US and China at the moment, that's more a war, but there are also examples for cross-border cooperation, and I think solar PV is actually the best example, which has come from a highly IP-heavy product to really a commoditized product, which can be mass manufactured in China. Now, what are the challenges? The challenges, and the key challenge really for the sector that I see, again, relates to the subsidy schemes. We have seen with the economic crisis, with the recession, with all the austerity packages, that many governments have actually turned around and cut subsidy support for renewables, which as such is not a disaster. It is a disaster though if it happens retrospectively, like in the example of Spain. Bulgaria has done the same, the Czech Republic has done the same, and there are ongoing litigations between the government and investors in Spain, for example, on solar installations, which has really caused a dramatic shock to the entire sector. If you invest in a solar PV plant and you rely, your investment is dependent on the assumptions that you make for the cash flows over 25 years, and you assume you have a guaranteed feed-in tariff, and then the government turns around and says, by the way, we're going to cut this tariff, so guess what, your return is 2% lower, that's just something that won't work. And so this is the key challenge at the moment. How can governments actually create an investment environment that stimulates investment and that gives investors the confidence that what they're signing up for is also what they will get. That's the key challenge. The other, on the economic viability, obviously another very important point, and that's from a regional perspective even more important for the US, with an abundance of shale gas being found and being available in the economy. Gas prices have dropped significantly. You see here, this was the forward curve in 2011. This is the forward curve today. So gas prices continue to drop, and that actually challenges the economic viability and the competitiveness of renewables. And that's a key question mark. Should you really invest so much in subsidizing offshore wind if you can keep the lights on for the same amount of houses with very cheap natural gas? It's important, and I think it's a good debate to have, but that's a challenge, and that's an important challenge for renewables. And on the global competitiveness, you will have followed that. Trade wars are taking place. There's a whole shakeout on the solar side. Should there be import penalties? on Chinese products, or should we continue as an open market? I think that will continue, but probably less a driver. What does that mean for the investor sentiment? When we look at the public markets, actually quite interesting. We were in boom times really in 2007, 2008, and the first large renewables IPO was actually EDF, Énergie Nouvelle, end of 2006. And that was already at a multiple, firm value over EBITDA multiple of 13 times. And then the peak really was when Iberdrola decided to float their business, their renewable business, which happened at 18 times. And the sector is now trading at 8, between 6 and 8. So you see, if you invested there, that was massive value destruction. And that has obviously not helped the whole, the public market sentiment for renewable stocks. Actually, they have only disappointed. When investors invested at these times, at the peak, what was important to them, they were hoping to have massive growth in the sector, and massive pipelines were put out. They were hoping to get huge dividends at some stage. Obviously, these stocks weren't paying dividends in the beginning. But what happened actually is that governments turned around as demand was actually falling, as they were faced with austerity measures. They were turning around, as we said before, and cut the subsidy support, and sometimes retrospectively. And that obviously is a complete game changer for your pipeline. If you have a pipeline of 5 gigawatts that comes on over the next 10 years and gets installed at different times, you're dependent on visibility of government support to value that. And that has led to a sentiment now where people are very, very selective on the geographies that they're looking at. So Spain is fundamentally uninvestable at this point in time, except for very distressed assets potentially, and people who are in restructuring mode. But people are really looking at what's the track record of the regulator, what's the stability of the system, how transparent is it? And the UK, with the energy market reform, frankly, has also lost quite a bit of credibility with the back and forth, and investors have very much criticized that. So stability and transparency is very, very important, and this is much more important now than people were not aware of this in 2008. So from a growth focus, and these stocks were very much growth stories, that was everything about them. We have now, people are now looking at the sector as a defensive play. Growth has not been delivered, and there's not that much that can be delivered. So these stocks have started, actually, the large developers have started paying dividends, to have been bought back by their parents subsequently because they were undervalued in the market, and they continue to face difficulties. In 2008, investors would easily give value to 5 years, 6, 7 years of pipeline. If you talk to investors now, they wouldn't even give you value for 1 year of pipeline. Why? Because it can change. So much can change in 1 year. The whole subsidy scheme can change, and that means your pipeline is worthless. When you now look at the private markets, how has M&A evolved? And you see that has actually been fairly steady since 2007. 2012 wasn't a great year. And this was marked mainly by privatizations or divestment programs. Utilities are now in the 6th year of restructuring, of balance sheet repair, of divestment programs, and this is very much reflected in here. And we expect that to continue. On the positive side, though, we've seen an increasing amount of financial investors coming to the space. Financial investors meaning pension funds. Actually, we have a slide on this. So pension funds, asset managers, insurers, We've seen the Japanese trading houses come into the space, looking at offshore wind, looking at the interconnections for offshore wind. We have seen private equity coming more into the space. Investors like Google, like IKEA, have taken stakes in offshore wind parks again. High net worth individuals are investing. So this is really a very, very positive development. And why are more people looking at this space and looking to deploy capital in this space? That's very simple. If you look at the real yield environment, and here we show the UK, it's actually negative. So if you're an Allianz or a Munich Re and you're faced with massive liabilities on the one hand, but you don't actually have an opportunity to get a decent return anywhere in the fixed income market, then real assets are a good bet. And on the face of it, or theoretically, a solar PV plant has a fixed feed-in tariff for 25 years and gives you a good return, maybe of 6%. And where do you get 6% here in the market? Nowhere. So what we've seen is actually an increasing number of passive institutional investors down here coming into the space at 6 to 8% returns, which is much less than, any of the typical investors, infra funds, private equity, would be willing to invest at. And that obviously creates pressure on people to either lower their returns or increase their risk appetite. And we've seen both. We've seen now infrastructure funds like Morgan Stanley has just said, we have to, with Allianz and Munich Re pricing us out of the market, we have to increase our risk appetite. And for the first time, we're willing to look at offshore wind, and we're willing to take development risk, and we're willing to take construction risk, which is quite surprising. And the utilities here, on the other hand, so they are in disposal mode. They all face the same issue. They'd like to deploy capital, but they don't have the capital. But they have huge development pipelines. So the key question is, brings me already to the outlook, how can utilities continue and developers continue to develop their pipelines, but share the burden of those heavy investments better? So in my mind, the outlook for the M&A market essentially, but also for the whole financing discussion, will be more of the same, but finding new structures as well, finding new structures that allow more institutional investors to actually participate in the build-out of renewables. For example, this could be a preferred equity structure. We're working on something where we try to actually structure an instrument for offshore wind that makes this essentially a fixed income security. So an investor can come in, take a stake in that, take a 50 million ticket instead of the 500 million that one direct investor would be required to put in, and does get essentially a risk wrap around it. So it's like a bond essentially, and that at very attractive rates. So trying to create innovative structures to bring more investors to the table and open up the space, I think will be one key theme over the next few years. On the public market side, we have actually seen very recently here in the UK, I don't know if you've followed it, an IPO by an entity called Greencoat. This is essentially a fund of operational assets, so carving out wind assets which are already operating, very low risk, and which yield a good return, 6% yield, that could be growing over time. And we think we'll see more of that. So you take out the risk that is associated with all the pipeline. There's no growth angle really, except for new additions to this fund operationally. But the focus again is a defensive one, it's on yield. And that attracts, again, this growing and large universe of yield investors. I think we'll see more of that, but people are also quite picky. There's a lot of capital to be deployed, but not every story will fly. For example, as I said, Southern Europe is just a red flag at the moment because governments have turned around and changed the regulation one too many times. And there was a solar vehicle that just tried to float on the Toronto Stock Exchange. 40% of the 500 megawatt roughly of solar capacity was installed in Italy. And despite lowering the price and increasing the yield that they would pay to investors, there was just not sufficient demand to actually list this vehicle. So this is just to say investors are not stupid. They don't take anything. They will be very selective on the stories they take, but for good stories there will be good appetite. And that's actually a brief overview of investor sentiment, M&A outlook. Any questions? Happy to take them.
You talked very briefly about competition, world competition. EU subsidies, 6th of June. What is the bank's view about how that may impact on EU solar?
EU subsidies?
Sorry, EU tariffs, apologies. For Chinese panels.
Okay. Well, frankly, it's a difficult discussion. I think there are different angles to that. From a political point of view, I think it's very, very valid to impose, impose higher tariffs or import penalties on Chinese products. From a market point of view, and then the bank's point of view, I think, it just prolongs the period of a necessary shakeout, frankly. I think there has to be, there has to be a shakeout, there has to be a survival of the fittest, and there has to be a period of adaptation where those that are not cost competitive fall out of the market. I think that this is something that will just prolong that process, but will not change actually the game. So in that respect.
Do you think it'd be a temporary blip and then over time disappear, the impact?
I think yes. That would be my view.
Thanks very much for the lecture. You've been stressing very much the importance of subsidies. Of course, the other way how this could be supported is through a meaningful carbon price. It was, originally probably the idea of the ETS, and I was just wondering if investors have totally given up on this, or they're still hoping for this, or they're pushing this, or they're opposed to this, or
I think there's a lot of confusion, frankly. When you look at share prices of the integrated utilities, or the more generation-heavy ones geared to upside from that, what we saw before the backloading vote was that essentially that was already priced in. There was already an upside price in of €5 per megawatt hour. Now I think the expectation is still that this will be successful, but nonetheless the expectation is also that this will not be a quant jump, may help 3-4 euros per megawatt hour, but not significantly. So yes, it can help, and yes, it would be, it would be seen as a positive thing. But I think the hopes are not that high that it would be a complete game changer.
You referred to the impact on the forward curve of gas prices of shale oil in the US. So let's leave aside government subsidies in Europe and elsewhere. Let's assume that grid parity for all these renewable technologies is the holy grail and some are getting there quicker than others. What impact do you see of shale oil discoveries and exploitation in Europe and in other parts of the world affecting those assumptions?
Well, if you have more of that shale gas coming to Europe essentially and bringing down power prices further, then obviously your grid parity chart will move to the left. So, it will drag out grid parity a bit further.
And what probability do you or the data you're looking at put on that? Because so far it's not being exploited in Europe or other countries, but presumably they will look at America and see what's possible. And apart from anything else, they'll have a lot of pressure from industry, manufacturing, saying our margins are going to be shredded by being uncompetitive with US industry.
Yeah, I think that the potential for shale gas in Europe is an interesting one, but it's nowhere comparable to the US. That's what our data, at least data interpretation, is that this is to be seen, but that certainly it's not of the same significance. And if there is some potential, then it comes at a higher cost. So it won't have the same impact. Will there be more imports? Will there be more LNG coming to Europe? Yes, probably a bit more, but the majority at the moment goes to Asia. And I think there's potential at the moment. What we see is almost three markets. There's the US, which has the cheapest energy costs, and there's Europe, which is somewhere in the middle, got some of that imported, and then there is Asia with the highest, actually, which is like a little bubble in itself. And so we see different subsidization also across those three markets.
I had a question. I was going to mention shale oil, but I was also going to mention the more global picture. We're in one of the worst recessions we've ever seen in our lifetime, and that's going to change, and America is changing, and eventually when Europe stops using austerity, maybe that will also change. But basically what I'm saying is the assumptions and the prices on which the studies are based seem to be a very depressed state of prices. Once demand picks up, you're going to make a lot of other alternative sources viable, and also oil prices are going to be more expensive. So have you factored this into the account? Because we're talking about NPVs and about the future, so we need to have the forecast about the future of world economy and all this. Are these incorporated into your picture?
Yes, that is incorporated. I mean, there is clearly, like, if you look in the very long term, things will definitely change. But unfortunately, the reality is that at this point in time, when we look across Europe, clean spark spreads or gross margins for a gas-fired power plant are not going to be positive until 2020. Meaning, power prices. Sorry.
Based on what kind of assumptions for growth in the world economy?
So based on EIA, for example, based on Sierra, based on Bloomberg, and this is looking at power prices, for example, over the next 5 years are sort of fairly constant around the €50 mark per megawatt hour. When you look at the UK market, that's probably the only market where we see a little bit of upside over the next few years because the market is tightening. But the problem is there's not much upside. Actually, there's new renewable capacity coming on stream in all of these markets. There's few plants that will be shut or will be closed down ahead of time. So net, probably either the capacity is stagnant or is going up even slightly, like in for example, in Germany, we would expect that. So the supply-demand balance is still out of sync. Demand has gone down significantly. And then we don't see much upside actually in commodity prices. And the combination of that means that pricing picture for the next 5-7 years may well remain as negative as it looks today. So this is all factored in, and that's not to say, at the moment you're right in saying, obviously when you look at economics of different technologies today, the most profitable and one of the few profitable generation technologies without subsidies is actually lignite, the dirtiest thing you can get. So this is lignite is very profitable. Hard coal is hardly profitable. Gas is not profitable, which is why we have the whole discussion around capacity payments. And renewables needs heavy subsidies from the taxpayer. But this picture will change. Obviously, it can change with CO2 prices going up, and it will change as demand will pick up, and reserve margins will, continue to look better, and prices hopefully will head up.
The heroes of one of your charts with the utilities. I'm not sure I'd ever imagined describing utilities as heroes, but they seem to be willing to take a lot of risk at a low rate of return. But of course their balance sheets are very stressed in some cases at the moment. Is there much appetite among investors that you can see for improving utility balance sheets through rights issues?
There is some appetite, but what they request in return or in exchange for actually putting their capital to work is quite a high dividend. So we see, for example, GDF Suez is leading the sector with a 9% dividend yield, which is crazy if you think about it. Earnings are going down. You have to take on more debt to be able to pay investors a dividend. So from a corporate finance perspective, that just doesn't make sense, really, frankly. But, that's what investors are asking for. But utilities, I know in the press, are always, or often actually pictured in a very negative way. But they take a lot of risks. For example, they front the offshore development and take all the construction risk, take the development risk of those parks at returns that a financial investor would never look at.
And do you think Germany and Japan, for example, were a bit hasty in closing down their power stations before having an alternative to replace it with?
My personal view is yes, I think they have been a bit hasty, but I don't think it will come back. Not in Germany, I think. The political or the public sentiment is very much against it. I think most people have not thought this through, have not actually calculated what that means and how we've filled that gap. And in the case of Japan, they have come up with the highest subsidies. It's like 3 times the German subsidy level for solar PV, which you can argue is very expensive, but that's how you incentivize investment, obviously, and it has worked. Is that a wise decision? In my view, being like Homo sapiens, and rational, I think that's not the best way, and the risks of nuclear really, are portrayed in the wrong way in the public. But I don't think, I think, it's obviously a mix. You can't just look at it from an economic perspective. You have to factor in the public sentiment and the pressure on politicians. And there was always an agenda behind it in Germany, and yeah.
So you said that basically the subsidies in Germany were too high initially, and obviously they have been reduced over the years. But thinking of Germany as a very rich country and as a country that actually can take that much, where basically where the consumers are able to pay a little bit more for their energy, isn't it the right way? Because economically speaking, what happened was that a lot of new businesses came out of that. So all of the small developers who installed the solar power plants on the roofs and so on, and also like Wacker Solar and Solar World and all of these companies, they profited, basically Q-Cells in those times profited from these subsidies a lot. So it's kind of, my question is basically, don't you think it's alright for a country like that, in that position, which is actually rich in resources and economically well, to make the consumers pay a little bit more, to turn around how the energy is generated to finally save the environment and the world?
I agree with the basic concept of, people should be paying more to make the world a better place and to make the world greener. But I think it needs to be sustainable, and it needs to be, thought through. What happened to all the jobs that were created? 90% of those businesses have gone bust in the meantime, or have actually gone out of the solar sector, have closed down their divisions. There's probably not one company that is still as invested in it as they were like 5 years ago. So that is a massive capital destruction. And it's also, you know, what does it help to create 100 jobs and then actually that they're gone after 5 years, and a lot of people have paid for that. But you know, I think it's just the way the incentives were designed. They were, you know, over subsidization in my mind is not right for any technology, frankly. I think it's good to make people pay for developing technologies and enabling cost reduction of those. But maybe then cost reduction needs to happen at a slower pace rather than over-subsidizing and making a lot of people lose a lot of money, essentially.
But also the poor are subsidising the rich investors.
Sorry?
The poor are also subsidising the rich investors.
Exactly.
Yeah, it's a reallocation of money if you think of it that way, essentially.
I think we should possibly reallocate ourselves. This is a well-designed lecture room, which means the people at the front can see the time and the audience can't. So you may be surprised to learn that an hour has passed in a fascinating discussion. So thank you very much indeed for that.